Welcome to this edition of Ethical, Sustainable Investment News and Analysis to Profit By. I'm Ron Robbins, an ethical investing pioneer for over 40 years, quoted in the Wall Street Journal, MarketWatch, the Globe and Mail, and numerous other global media, and founder of the world-acclaimed ethical, sustainable investing information website, Investing for the Soul. And please note my disclosure statement at the end of the podcast. Now enjoy this podcast. Hello, Ron Robbins here. Welcome to my podcast, Ethical and Sustainable Investing News to Profit By, presented by Investing for the Soul, March 15th, 2019. At the beginning of each podcast, I like to suggest that if any terms are unfamiliar to you, you might like to go to Investopedia and scroll down to the very bottom to see their A to Z dictionary. Also, you can find a full transcript and live links of this podcast at my podcast page located at investingforthesoul.com/podcasts. This edition, I'm going to cover several items that I believe are the most important items for News to Profit By listeners. Plus, I'll be doing a special review of Robo-Advisors and their offerings for ethical and sustainable investing. The four most recent newsworthy items, in my opinion, for ethical and sustainable investing are: 1. Who runs the world? The global status of women in leadership. Second article, ESG investing does not cost more, research shows. Third article, the 100 most sustainable US companies. And fourthly, sustainable and ethical standards are in vogue, but only governance is affecting ratings, Fitch finds. So let's start with the first article. Who runs the world? The global status of women in leadership, by Sophie L'Helias and Adria Vasil, March 9th, 2019, Corporate Knights, Canada. This is a quote from the article. Regardless of progress at the board level, the glaring reality is that the world's largest corporations are stored in second gear when it comes to hiring women in C-suite leadership roles, such as in CEO, CFO, CIO, and so forth. They lag behind in gender in all markets. Although several reputable studies have shown that having women and diversities on boards and in management generally leads to superior financial performance, corporations generally have been slow to include them. Some further thoughts on this. Firstly, the study covered 1,500 largest publicly traded companies for more than 3 years. Secondly, in the article, there's a great country breakdown, and it shows, as usual, Scandinavian countries leading. But progress is being made by women, and as an investor interested in ethical and sustainable investing, you might want to consider, when investing, the proportion of women and diversities on the boards and in management of the companies you're interested in. Furthermore, there are several new funds that specifically invest in companies with high proportions of women in management. They include Impact Shares YWCA Women's Empowerment ETF on the New York's NYSE ARCA exchange under the ticker WOMN. In Canada, the RBC Vision Women's Leadership MSCI Canada Index ETF RLDR on the Equitas Neo exchange. In the UK, there's Barclays Women in Leadership Total Return Index ETF tracker, ticker symbol WIL. So they'll be good to look at. Second article, ESG investing does not cost more, research shows, by Frank van Alphen, February 19th, 2019, IPE, that's the publication in the UK. Quoting the article, pension funds performing well on environmental, social and corporate governance factors don't incur higher asset management costs, according to the research. The research was done by Dutch consultant Gaston Segelier, indicated that improvements to investors' ESG policies did not increase costs either. These were Dutch pension funds that were studied. Now, most people believe that ESG investing does cost more. However, the big differential that once existed is now much lower. Also, It used to be that ethical and sustainable funds were small, that ESG information was not as available, and was expensive to produce. So for those reasons, ethical and sustainable funds did have significantly higher fees. But the situation today is quite different. Vanguard in the US, for instance, now has sustainable funds with fees as low as 0.12% annually. The third article we want to look at, the 100 Most Sustainable US Companies by Leslie P. Norton, February 8, 2019 in Barron's, USA. Barron's list is compiled by well-known and respected SRI fund company Calvert Research and Management. Hence, it's to be respected. Calvert has been around since 1982 and helped pioneer socially responsible investing in the US. To create the list, Calvert rated the SRI, that's the socially responsible investment credentials, of the 1,000 largest by market capitalization publicly held companies headquartered and incorporated in the US. I have a link in my transcript to the article as well as much more detail on the companies looked at. Interestingly, the top 5 American companies are Best Buy, Cisco Systems, Agilent Technologies, HP Inc., and Texas Instruments. The fourth article to look at, sustainable and ethical standards are in vogue, but only governance is affected by ratings, Fitch finds, by Chad Bray, February 26, 2019, South China Morning Post, courtesy of Yahoo, Hong Kong. This is a fascinating stat from the article. Quote, the credit rating agency, however, found that less than 1% of financial institutions have ESG factors that have actually driven a ratings change, with governance risk being the biggest issue. Governance includes such things as executive pay, audits, and efforts to weed out money laundering. 2 key points stand out in Fitch's findings. Firstly, how small an impact ESG is having on credit ratings. It makes me wonder how much credit rating agencies utilize ESG criteria. Secondly, Fitch doesn't say if the analysis was only from their company or if other ratings agencies were involved. For instance, it would be interesting to know what differences there are in the use of ESG criteria between agencies. Ethical investors particularly might find that useful. Now, despite the fact that at this point they believe not too much happens in relation to ESG and ratings, I beg to differ that as they get really into it, that they're going to find much, much, much more. And this is why ESG is becoming standard mainstream practice among investment analysts globally. So I do believe in the future we'll see that just as ratings agencies grade bonds, AAA, BBB, etc., they're likely to add an ESG credit rating grades to stocks. This could really revolutionize how we make investment decisions. Now for my special review of Robo-Advisors. These are automated app-based low-cost investment platforms. So rather than going to, say, an investment advisor or stockbroker and getting advice on funds or stocks from them, there are now these apps called Robo-Advisors to do all that work for you. There was recently a great review of these in a post titled, Is Your Ethical Investing App Upselling Greenwash? By Adria Vasil, March 5th, 2019 in Corporate Knights, Canada. Corporate Knights have produced one of the few really good analytical studies on ethical investing apps for North Americans. They believe there are some good robo-apps for Americans, but not so for Canadians. Before going into their findings, let me make some points. My principal concern with robo-investing apps for ethical and sustainable investing is that they will still put you into at least a few investments that don't reflect your personal values. And you're going to feel quite sad about that. You rarely, if ever, really feel completely comfortable with everything in their portfolio. This is because they nearly all use low-cost ESG ETFs. These are mostly passive, that is, not actively managed funds, but the big drawback is that they're based on ESG indexes, and these indexes will rarely match your personal values. or at least all your personal values. Also, these indexes tend to be poorly diversified. Often they're overweight in tech and financial stocks too. The 100 most sustainable US companies reviewed above is a clear example of this, as their top 5 companies are related to tech. So it's a bit like putting all your eggs in one basket, and that's never a good idea. Also, many of the robo-advisors are new financial entities. What happens to your money if the management firm dissolves, for whatever reason? That is a concern rarely discussed, but if you're looking at long-term investing, it's a very real consideration. Now, in most developed countries, there are usually government regulations concerning such investments, so your actual principal might have a degree of protection. It's something you want to look at. Also, with many data breaches in the news, how secure is your information on their site? It's for these and many other reasons that I suggest those interested in ethical and sustainable investing take my 1-hour DIY ethical sustainable investing page tutorial before even considering robo-advisors or in fact investing at all. In my tutorial, you'll easily learn how to create a portfolio of stocks that truly represent your personal values. And no financial knowledge is required, and you won't have to bother with any math. Furthermore, creating your own stock portfolio will likely cost you even less than the lowest fee robo-advisor. However, should you want to review some ethical, sustainable investing robo-advisors, I suggest you look at those in the Corporate Knights post. They have quite a detailed breakdown by robo-advisor. But do your own research and perhaps check with an investment professional before deciding for yourself. For Americans, Corporate Knights suggests looking at Swell and Open Invest. They're the top 2 there. While Corporate Knights says, quoting, for Canadians, well, robo-advisors may not be the best route for you until the companies behind them offer more truly values-driven options. Close quotes. For listeners elsewhere, you might want to do a web search for reviews of robo-advisors in your country. As you would expect, robo-advisors are largely targeted at younger, tech-oriented investors. So read the research on them by Corporate Knights and other trustworthy sources. But remember my remarks here. Well, that's all I want to cover in this edition, but let me make a few final points. To download the transcript of this podcast and get all the links mentioned here, please go to investingforthesoul.com/podcasts and look for this edition. And remember, I'm here to help you grow in your investment success and investing in opportunities that reflect your personal values. So please don't hesitate to contact me if you have any questions about this podcast or for anything else related to investments. Remember though, I won't make any buy or sell recommendations for you. A big thank you for listening, and please click any of the share buttons to share this podcast with your friends and family. Thank you, and bye for now. Learn how to create a simple portfolio reflecting your personal values by taking my 1-hour tutorial. Go to investingforthesoul.com/podcasts and click the link there for my do-it-yourself ethical sustainable investing page tutorial. And don't forget to subscribe to my podcast using whatever app or site you get your podcasts from. Now, as I indicated earlier, I want to offer full disclosure. That means I'll mention in the show if I have any direct interest or holdings in companies or securities I'm talking about. Also, any favorable or unfavorable comments I make concerning companies or securities should not be considered investment recommendations. And furthermore, I cannot guarantee the accuracy or incur any responsibility or liability for any information herein. Please do contact me. I love to hear from you. I'm at ronr@investingforthesoul.com. Signing off, this is Ron Robbins.